Hello traders, it's Samurai Trader here. In this session we will cover the 34B, which is the 34 EMA trend bounce, the 89B, which is an 89 EMA trend bounce, and the 200B, which is a 200 EMA bounce. So they're all three of them are trend following strategies. Now it's a very mechanical trade within itself. That is because we're looking for either one or all of the moving averages to be trending in our trade direction. As far as accuracy goes, your best is your 34, then your 89, and your 200. They all can work very well together. If you wish to simplify your trades, and if you said to me which are the best two, well, your 34 EMA bounce and your 89B are your best ones. In fact, many traders, when they're trading, they'll apply a 34 EMA moving average on their charts, and if price trades above the 34, they will only take long trades. If price is below the 34, they will only take short trades. As I mention in every video, please feel free to make this or put this on full screen down the bottom left hand side here, sorry, right hand side I should say. It'll just make it a little easier when you're looking at the charts. And on top of that, as I always put on, is the risk disclaimer. Please feel free to put a stop to the video and read this in detail. Now, discipline is like a muscle. The more often you practice it, the stronger you get. And I think there's nothing more applicable. I think it really says it all when it comes to trading. One of the biggest challenges for us as traders is to wait for the ideal conditions. And the more often you do this, the more often you practice discipline, the better you become at it. The very best traders I know are highly disciplined. Now, what makes trading easier for me is I've managed to reframe myself or step in the shoes, if you like, of a sniper. That is, I'm just patiently waiting for the best trades. One shot, one kill. And you need to have that attitude, in my opinion, when it comes to trading as well. And I think you'll find it will make trading a lot easier. And the more often you do it, the easier it becomes. Because when it comes to trading these particular trades, you don't get a lot of trades. That is, you might get 1 to 2 an hour. Some may consider that a lot. Some of your scalpers will say that's nowhere near as many as I'd like. However, they're very profitable. So that's what this business is all about, is making money. So let's have a look at some trade setups. Now, these setups work on all time frames and all markets, whether you be trading range or tick bars, Renko or time. The setups work in all markets, all time frames, and as you're about to see, they're very mechanical in nature. So if we look at the top left hand side, we can see prices come down and kissed or bounced directly off the 34 EMA. So the yellow is our 34, the cyan is our 89, and the purple line here is our 200. So the 200 is not as accurate as your 34 and 89. Now, I've covered profit targets in a separate video, but you can see here we had an entry. If you're waiting for your T1 signal, and this is one of the beauties of this trade setup, it's really about having a pullback and then a bounce. So you're waiting for a retracement, which usually leads to a T1 signal, a paint bar appearing. It would not have appeared until this candle here. So you would have been front running if you had have had your pivots on to about here anyway. So it wasn't a hugely profitable trade, but it still would have made you money if you were targeting the pivot. Down here we had an 89 bounce. Now what you can do is, to confirm your trade, you can use your zero leg, of course, and you can see here where our zero leg turned from magenta to cyan. But there's one thing that would have kept you out of this particular trade if you're using the 34 EMA, and that is the angle of the 34 EMA. What was the rule? if price action is above the 34 and the 34 EMA is sloping, you go long. If it's trending down and price action is under, you go short. So we can see here price action is under and we're starting to slope down. So you may or may not have taken this particular trade, depends how mechanical you are. There's also another signal here that you could take notice of is look at our long-term stochastic. Notice how it's oversold. So this is setting up for what sort of trade? A T2, and you can see it's setting up perfectly there, a T2. Remember, with T2s it's a trend following trade. So you had a nice 34 bounce here, you had a nice 34 EMA bounce, we've rolled over, price action's gone up, bounced off it, price action's come down. We now have a convergence of the 200, the 34 and the 89. Price action goes up, and what happens? It then bounces off, as you can see. Down here, let me actually scroll across. You've got your long-term stochastic rolling down, you've actually got a T10, a T2, but we come over and let's stay focused on these trade setups in this video. We've now got another 34 bounce. You can see it just here. Here's your 34, which is your yellow line. It comes down, rolls over. Now if you had been waiting for the T1 to signal to appear, it would have been on this candle, which is when your zig lag rolls over as well. Once again, your zero lag will get you in a little later. However, it'll keep you out of a number of losing trades as well. Many traders feel more comfortable in waiting for the zero lag to confirm. So we can see it here where it's gone from cyan over to magenta here. Traveling along, we've gone back up, we've passed through the 34 starting to level off a little bit, but we can see here on our 89 we've still got a strong trend down. The 200 is trending down, so you actually had a trade entry here as well. If you're waiting for the zero lag, you would have been over here. But also if we look at the time, and this time here was the market had been open for around 20 minutes, so you're going to get a lot more volatility in the market on these floor pivots here. This is midnight here in Australia, so we can see right now we're starting to bounce around on these pivots. This is still a good example to give you and to show you because you are going to have what we call chop. Now what will we do in this particular case? Because we can see our 34 EMA is in an uptrend, then it starts to roll over, it's going sideways. Well traders, this is the million-dollar question that we have every time we trade. As you'd be aware, I love the pivot bounces. We've come up here, we've got a nice pivot bounce here, we've got another one here, we've gone up, we've tested it again. My 200 is in a strong downtrend, and this is almost a 200 EMA. One of the things you can do if you really want to keep your trading mechanical, to qualify as, for an example, an 89 bounce or a 200 bounce or a 34 bounce, you've got to touch the candle. Sorry, your candles have got to touch the EMAs as we did here. So in this particular case, you'd be very safe in following your 200, or because your 34 and your 89 is going sideways and our long-term stochastic is in the middle of a window, standing aside and waiting for a new lower low. So let me say that again. Our MAs are going sideways, our long-term stochastic, so what I want to look for is a breakaway or a breakout, either a higher high or a lower low, and here we ended up getting a breakout. We had a lower low. You can see here we've broken this low. I wait for the pullback, and what do I get? An 89 EMA bounce and virtually a 34 bounce. My 200 still heading down. Traveling along a little further, I then get a pivot bounce, which happens to be a 200 bounce as well. Then price is closed above my 34. So price action is obviously starting to change direction. Now a lot of traders don't like trading, including myself, against a pivot, and a pivot is quite often very strong resistance or support. So here you can see it's been resistance. We've potted around here before finally we've had a breakthrough, and away it's gone. You had another 34 bounce over here, which also happens to be a T2. This is not uncommon, by the way. You'll see quite often you'll get a lot of trade strategies firing off together. For an example, down here you've got a T10, you've got a rising long-term stochastic, your short-term's rolled over, and away we go, and we see a bounce. It's up against the pivot. Now in looking at some of these, just remember you will have what we call aha moments. Aha, that's how that works. So if it's not all fully sinking in right now, just go back and watch it, and of course set this up and do it on your own screen, on your own markets, and just give yourself some time for it all to sink in. So here we had a 34 bounce, sorry, an 89 and a 34 bounce. Now here in this particular case, this is a really good example of waiting for your zero leg to confirm the trade. So see how our zero leg's coming down. We had a T1, an entry signal here, but yet it was a false signal because our zero leg is still in a downtrend. You can see that there. Now remembering, if you had, say, waited for this bounce off both and entered here, or you may have even entered here, you still would have been in this trade, because remember your stop's always going to be 2 ticks below your swing low. So remember your stop's going to be tucked down here. So if you're waiting for T1s, and just on that side, I really like to wait for the paint bar to appear, or for the rule of two to be applicable. That is 2 then a tick above the 2 bars. And the reason I like to do that, it makes it more mechanical. Trading is a lot easier when you're working on mechanics, or on a rules-based strategy. Down here once again we had a lovely T2 which coincided with a 34 bounce virtually. You can see that there. So see that there, you've got a beautiful T2. Then over here we then had a T10, but we're also rolling over. So let's move along here, and what do we've got here? A 34B, a 34 bounce, then we've got another 34 bounce here. Now remember the rule of 3 waves. Keep a count of how many trade entries you have in a trend, because after 3, quite often the numbers are going to start to stack against you. That is, the greater probabilities for a change in trend. So you would have had a trade entry here being a T1 signal, and virtually a T2 as well, a couple of candles along. You had a T2 there, you had a 34 bounce here, and you had another 34 bounce here. Now where would have your logical point have been to get out? Well, you can see here, besides a pivot, if you don't have pivots, look at what's the lowest low you've got. Remember to front run, always have your exit a little higher than your closest lowest low, because that's usually going to provide some resistance. So let's move along here and see what happens. We can see our 34 EMA is now going up, and this is something you'll see a lot of, is a lot of confusion and consolidation, where you see your 89 is starting to go sideways, your 34 is now in a definite uptrend, and of course we punch up through. So what do? Well, I believe that if you're going to trade the 34 EMA bounces, you've got to take every single bounce. It's no good. You've got to be very careful when you're cherry picking a strategy like this, because it's very mechanical in nature. But there's also something that'll give you an extra hint on what to do. It's in this lower window. You can see here that we have a rising long-term stochastic. Now if you've watched the T1, T2 and T10 trading strategy video, you'll know that this is very important part of our strategy, particularly in trading the T2 and the T10, because when we have a rise in long-term stochastic and a pullback like this, it generally indicates a rising market, and you can see we're slowly going up, and this would actually qualify as a T10 even though the 89 and the 200 is falling down. Now I don't want to confuse you, but here's something I'd like you to consider and to remember. If you have a trade entry that's closer to the 89, you've got to be more cautious, because quite often you'll get this bouncing effect off the 89. So if you're going to follow the 34, it's going sideways here. You may say, well, look, let's just stand aside, except you then had down here, we had that beautiful T10 entry, then you have a T2. Remember, and let me remind you, a T2 is where we have the long-term stochastic either oversold or overbought, as in this case. For short-term comes down below the 50% level over here, which it's done, and we happen to actually get then, and it wouldn't have actually indicated till here, a paint bar, a bounce off for 34, and up we go. Now here you could almost say that was an 89 bounce, nearly a 200, but here, because of our long-term stochastic being overbought, that takes precedence in this particular case. Let me scroll a little further along, and here's another couple of classic examples. So here you can see I'm not cherry picking the days, I'm just taking every signal. So over here we've got another beautiful 34 EMA bounce and an 89 bounce. It's gone up and bounced off both. So then prices come down. It's then been bouncing for a while on the pivot, and when you see price action bouncing on a pivot continually, generally speaking, it's a good signal that you're going to get a breakthrough. Finally we had a small breakthrough support here, then it bounced down, bounced up. So you can see it there with 34's rolled over, the 89 EMA is rolled over, the 200 is rolled over, we've gone up, we've touched it, we get a T1 signal formation. If you're waiting for the zero leg, your entry would not have been until this candle here, and away you go. Now here's something, just why I think of it, I'd like to mention. Your first trade in a rollover or in a new trend, you're going to generally have the best opportunity for a higher profit target. Why? Because it's the first trade in a new trend. So you can do it on the second, but particularly if the first one, if everything's rolled over like this, it's a pretty good indication that price is in a downtrend. So therefore you can have a lot more, or a much better profit target, and this is where you easily pick up your 21 ticks in trades like this when you travel right down. And on the NQ, 21 ticks is $105 less your brokerage, it's 100 net. So you had a beautiful 34 bounce here and a bounce here, and 527 price action trading for the day is just about finished, and we go up through, we come down 5:43 a.m. my time, which New York, it's what's that again? Sorry, it's 3:45. I think it's 3:45. Market's heading towards the close. Sorry traders, it's been a long day today, and we get a bounce again, a lovely bounce off for 34. So you can see why trading the 34 and the 89 bounces, and the generally speaking the 200, there hasn't been too many good ones on this particular day, but your 34 EMAs and your 89 EMA bounces are high probability trades. Now getting back to what I mentioned earlier about having the discipline and the patience, and where I speak to dozens of traders over a month, and the many seminars that I do, and the coaching with the traders, that professional traders that I work with, the biggest challenge they have generally is discipline, is sitting back and patiently waiting. and just look at how many of these 34 and 89 bounces worked in this one particular trading day. So let's now have a look at trading the forex market using the exact same setup. Now in this particular case, I've just taken the Euro USD EUR USD 5 range. Once again, you can use tick charts, time charts, range, Renko. I just happen to be a great lover in this particular market of using range, where of course you saw earlier on the NQ I preferred tick. Now here with forex, there are certain times of day where you're going to have, it's going to be a lot more volatile. Of course, you've got your three main trading sessions. You've got London leading then into New York and leading into the Asian session. One of the things I love about forex is there are so many thousands of technical traders around the world, and it's a great market for technical trading. As many of you can see here, we've got some beautiful T89s here. Now if I remember correctly, this is Friday's action, and that was the FOMC announcement. So I have to mention, forget that move right there, because if you were sensible, in my opinion, unless you're trading a news related EA expert advisor, I would not have been trading that particular trade. In actual fact, I stay well out of the market for an hour each side on FOMC market days. But let's ignore that for a moment, because we're really talking about the bounces here right now. So we can see here we've come down and we've bounced, we've bounced off the 89. Up here we've got another 34 bounce, we've got a 34, we go up, bounce off, come down, and we've got an 89. Up here we've got the 34, we've got another 34. Now remember, each one of these candles, if you're trading a standard lot, is $50. Now your stop would be 1 to 2 ticks below your little swing low. And this is another thing I need to mention, is that you need to consider this in whichever market you're trading. At times you're not going to have your stop below this swing low, because a lot of these trades are momentum trades, which means if it's going to go back against you, it's going to go against you. So therefore you may just be using your entry candle being a couple of ticks below there, but that's covered on another video. So let's come over here. At last we've got a 200 bounce. See that there? We've come down, we're a lovely little double top up here, may as well mention that. We've come down and we've had a bounce off the 200 EMA. We travel along, we punch up, we come down. This is really a pivot bounce, an 89 bounce. So your 89 there, your cyan lines going sideways a little bit, we're starting to rise, and away it goes. Over here you've got a 34 bounce, you've got a 34 bounce here, and you've got a 34 bounce there as well. So down here we've got an 89. You can see here though your 34 is really rolling over, and this is basically the, where are we here, the close, sorry trade, I'm just getting my date right, if it's right. Come down here, you've got 89 bounces here. So you can just take any day, and here we've got a bounce here off your 34, you've got a 34 bounce, and you're going up against the pivots here. 34 bounce, and you've got a 200 bounce, and let's see what's happening with that 200 bounce. See, look at that support around that 200. Not only have you got a pivot, but you've got your 200 EMA giving you support there as well. So traders, what I recommend is you go back and you back test a minimum of 100 signals on the time frame you're going to trade. One thing I can't give you screen time. I can give you the best trading advice and some of the best research. For an example, in researching the 34 bounce here, I went back to a research paper that we put together nearly 10 years ago, which I'm just looking at here on the 34 MA bounce. and what I said here in this research report 10 years ago, the 34 MA bounce is a trend following scalp strategy that buys or sells retracements touching the 34 MA. This strategy is purely mechanical and eliminates any subjectivity or discretion in taking valid setups. Trades are only taken with the trend, and these are executed when the MA is trending. This means as long as the MA is not flat, trades can be made or taken. So what I've done is advanced since then, over 10 years ago from this original rules, and I prefer the EMA, but there's hardly any difference in it, traders, very little. So in recap, the 34B, the 89B, and a 200B are highly profitable standalone trading strategies, and if you are patient, you'll have many of these each and every day on virtually every market. And why are they so successful? Because so many other traders trade them as well. Thank you, traders. Any questions, please drop me an email. Otherwise, I'll see you on our next video.